Out of all the technologies emerging in the world right now, why is cryptocurrency, and specifically XRP, such an insanely interesting opportunity? Welcome back to Lion of Crypto. If you are serious about understanding where money is flowing next and how financial systems are evolving, you are in the right place. On this channel, we don't just follow hype. We break down macro trends, infrastructure shifts, and real capital movement. Today, I'm going to explain in very simple terms why crypto is not just another trend, why blockchain is not just speculation, and why XRP may be positioned in a very unique way inside this transformation. Let's zoom out first. Before we even talk about XRP, we need to understand the bigger picture. Over the last 25 years, the internet has completely transformed society. Communication changed, commerce changed, media changed, transportation changed. We moved from physical letters to instant messaging, from physical stores to Amazon-style online shopping, from CDs to streaming. The internet did not just improve these industries, it rebuilt them from the ground up. But here's something most people do not think about. The core plumbing of the financial system has not changed in the same way. Yes, we have apps like PayPal and Venmo. Yes, we have mobile banking. But those are just modern interfaces sitting on top of very old settlement systems. It is like repainting a car from the 1980s and calling it brand new. The outside looks clean, but the engine underneath is still outdated. Today, if you send money internationally, it can take 3 to 5 days. Fees can be around 2 to 3%, or sometimes even more, depending on the corridor. Compare that to how information moves. You can send a message from Pakistan to the United States in 1 second, basically free. Why is money slower than a WhatsApp message? The answer is infrastructure. Information has the internet. Value does not, at least not fully yet. This is where blockchain comes in. Blockchain technology is often misunderstood as just crypto coins, but at its core, it is about building an internet of value. Just like the internet allowed information to move instantly, blockchain allows value to move instantly. Instead of banks reconciling ledgers behind the scenes for days, distributed systems can settle transactions in seconds. This shift is not small. This is not just a new app. This is potentially the digitization of every asset: real estate, stocks, bonds, commodities, derivatives. All of these currently sit on legacy systems built decades ago. If these assets move to digital rails, settlement becomes faster, cheaper, and more transparent. That reduces friction, and in free markets, lower friction always wins over time. History shows us something important. When a better technology appears, resistance does not stop it. At first, people doubted online shopping. They doubted streaming music. They doubted ride-sharing apps. But efficiency always attracts capital. Businesses follow cost savings. Investors follow growth. Consumers follow convenience. Now apply that same logic to finance. If a system can move money faster, cheaper, and with fewer intermediaries, over time, capital will migrate toward it. Regulations may slow it down. Large incumbents may resist. But if cost savings are significant, adoption becomes economic logic, not ideology. This brings us to XRP and the XRP ledger. There are many blockchain projects, thousands actually. Most are experimenting, some are innovative, but very few are directly targeting the core plumbing of global finance in a practical, enterprise-focused way. XRP was designed specifically for payments and liquidity movement. The company behind much of its enterprise push, Ripple, has focused heavily on working with financial institutions rather than retail speculation. This is a very important difference. Many crypto projects build technology and then hope users come. Ripple built a strategy around partnering with banks, payment providers, and financial companies from the beginning. The XRP ledger is built for speed and low transaction costs. Transactions settle in seconds. Fees are extremely small. For cross-border payments, that matters a lot. If a bank can reduce settlement time from days to seconds and cut liquidity costs, that is not just a technical improvement, it is a balance sheet improvement. Another important factor is integration. Large financial institutions do not want to rebuild everything from scratch. They want solutions that fit into their existing compliance frameworks and operational systems. Ripple's strategy has been to create products that institutions can plug into, often without needing to understand the deep technical complexity underneath. Think about it like this. When you use a banking app, you do not care how the back-end settlement works. You just want your transfer to complete. Financial institutions think the same way. They want reliability, compliance, and efficiency. If XRP infrastructure can provide that behind the scenes, adoption becomes easier. Also, Ripple has invested heavily in regulatory engagement. Whether people agree with every outcome or not, the fact is that long-term institutional adoption requires regulatory clarity. That is a major barrier for many crypto projects. Enterprise finance cannot operate in legal uncertainty for long periods. Now, does this guarantee success? No. Nothing in markets is guaranteed. But from a structural positioning perspective, XRP is not just trying to be digital gold or a meme asset. It is targeting liquidity flows, one of the largest markets in the world. Global cross-border payments alone represent trillions of dollars annually. Even a small share of that flowing through digital rails could be significant. The bigger idea here is this. We are likely watching the gradual digitization of financial infrastructure. Just like the internet digitized communication, blockchain may digitize settlement and asset transfer. If that thesis plays out, the winners will likely be networks that combine efficiency, compliance, institutional integration, and real-world use cases. From that lens, XRP becomes interesting not because of hype, but because of positioning. It is aiming directly at the plumbing of global finance, not just retail speculation. Whether it ultimately dominates or shares the space with others remains to be seen. But the macro transformation it is aligned with is very real. And as investors, the key question is simple. Do we believe that better, faster, and cheaper financial rails will eventually replace slower, more expensive ones? If the answer is yes, then studying projects like XRP is not optional. It is strategic. This is just the beginning of the breakdown. In the next part, we will go deeper into competitive positioning, risk factors, liquidity dynamics, and what needs to happen for XRP to truly capture meaningful market share in this evolving financial landscape. Now, let's go deeper. It is one thing to understand the big macro shift from analog finance to digital finance. It is another thing to understand competition risks and what actually needs to happen for XRP to capture real value. Because here is the truth most people ignore. A good story is not enough. A big market is not enough. Even strong technology is not enough. Execution and adoption are everything. When we talk about cross-border payments, we are talking about a massive industry. Traditional systems like SWIFT process trillions of dollars in transfers between banks every single day. That system works, but it is slow and requires multiple intermediary banks. Each intermediary adds time, cost, and friction. That friction creates trapped capital. Banks have to pre-fund accounts in foreign countries just to make sure payments clear. That is inefficient use of money. This is where XRP's liquidity model becomes important. Instead of pre-funding accounts around the world, a digital asset like XRP can act as a bridge currency. Let's simplify this. Imagine Bank A in one country wants to send money to Bank B in another country. Instead of holding foreign currency in advance, Bank A converts its local currency into XRP, sends it across the XRP ledger in seconds, and Bank B converts it into its local currency. The transaction settles almost instantly, and liquidity is freed up. If this model works at scale, it reduces the need for billions of dollars sitting idle in Nostro and Vostro accounts globally. That is a serious efficiency gain. In finance, freeing up idle capital is powerful because capital can then be redeployed elsewhere for profit. But we must also address competition. XRP is not the only blockchain aiming at payments. Stablecoins like USDT and USDC are widely used for transfers today. Central bank digital currencies, CBDCs, are being explored by governments. Other blockchains, such as Ethereum and newer high-speed networks, also claim to support fast transactions. So what differentiates XRP? One major factor is focus. The XRP ledger was built specifically for payments from day one. It is not trying to support thousands of complex smart contracts in the same way some other chains are. That narrow focus can be a strength because it optimizes the network for speed, low fees, and reliability in transactions. Another differentiator is enterprise strategy. Ripple has spent years building relationships with financial institutions, regulators, and payment providers. Enterprise adoption does not happen overnight. It requires trust, legal clarity, compliance standards, and integration support. This is slow work. But slow work can create durable positioning. Now let's talk about risk. Honestly, regulatory risk has been one of the biggest overhangs for XRP investors. Legal battles, uncertainty about classification, and shifting policies can impact price and adoption. Institutional players need clarity before committing significant capital. Any long-term XRP thesis must assume continued progress toward regulatory clarity in major markets. There is also market risk. Even if the technology is strong, adoption could move slower than investors expect. Financial institutions are conservative by nature. They move carefully. Integration cycles can take years. That means price appreciation tied purely to speculation can disconnect from real adoption timelines. Another factor is token economics. For XRP to gain significant value from utility, transaction volume on the network must increase meaningfully. It is not enough for the ledger to exist. It must process large-scale, high-value transfers consistently. That requires partnerships turning into production-level usage, not just pilot programs. Let's also understand something important about liquidity. For XRP to function as a bridge asset at scale, it needs deep liquidity across many currency pairs. Liquidity reduces slippage. It ensures that large transfers do not significantly move price. This is where exchanges, market makers, and institutional desks play a role. Without sufficient liquidity, large banks would hesitate to rely on it. Now, zoom out again. Global cross-border payments are measured in the tens of trillions annually. Even capturing a small percentage of that flow could represent massive transaction volume. But markets price expectations ahead of reality. That means speculation often runs ahead of adoption, and corrections follow when timelines stretch. As an investor, you must separate narrative from execution. The narrative is strong. Digitization of financial infrastructure, efficiency gains, global liquidity transformation. The execution question is, can XRP consistently demonstrate cost savings, reliability, and regulatory compliance at scale? Another critical angle is network effects. Financial infrastructure benefits from network effects. The more institutions using a system, the more valuable it becomes to others. Early adoption matters because once a network reaches critical mass, switching costs for competitors increase. However, financial systems are not replaced overnight. They evolve gradually. Hybrid models may exist for years, where traditional rails and digital rails operate side by side. This means XRP's growth, if it happens, may look more like steady infrastructure expansion rather than explosive overnight dominance. We also need to talk about investor psychology. Crypto markets are extremely volatile. Prices move on sentiment, macro liquidity conditions, Bitcoin cycles, and global risk appetite. Even if XRP's long-term fundamentals improve, short-term price action can remain unpredictable. That is why position sizing and risk management matter. The real opportunity here is asymmetric risk. If digital settlement networks become mainstream infrastructure, assets aligned with that infrastructure could benefit significantly. But if adoption stalls or better solutions dominate, returns may underperform expectations. So the key question for serious investors is not, will XRP 100x next month? The better question is XRP strategically positioned in a multi-decade shift toward digital value transfer? If the answer is yes, then patience becomes part of the strategy. In free markets, efficiency wins over time, but time can be longer than most retail investors are emotionally prepared for. The transformation from physical mail to email did not happen in 1 year. The rise of e-commerce did not dominate overnight. Infrastructure shifts require persistence. Now, let's step back and look at something that most retail investors ignore: macro liquidity. Because no matter how strong a technology is, capital flows ultimately determine price performance. Crypto does not move in isolation. XRP does not move in isolation. It is deeply connected to global liquidity cycles, interest rates, risk appetite, and monetary policy. First, understand this simple principle. When global liquidity expands, risk assets tend to rise. When liquidity contracts, risk assets struggle. This includes stocks, real estate, emerging markets, and especially cryptocurrencies. Crypto is considered a high-risk asset class. That means when central banks are printing money, lowering interest rates, and encouraging borrowing, speculative capital flows into assets like XRP. When central banks tighten policy, raise rates, and remove liquidity from the system, capital pulls back. Over the past decade, global markets experienced periods of aggressive monetary expansion. That environment fueled massive rallies in technology stocks and crypto assets. But when inflation rises and central banks tighten, liquidity dries up. We saw how quickly crypto markets can correct when macro conditions turn restrictive. So, if you are analyzing XRP purely from a technology standpoint without understanding macro cycles, you are missing half the picture. Even if adoption is growing steadily behind the scenes, price may not reflect that immediately if global liquidity conditions are tight. Now think about the long-term structural shift happening. Governments around the world are heavily indebted. Debt levels are historically high. In such an environment, central banks often face pressure to maintain manageable interest rates. Over long periods, this can lead to continued monetary expansion. And when liquidity eventually expands again, digital assets often benefit disproportionately because they are viewed as growth and innovation plays. Another macro angle is de-dollarization and cross-border trade shifts. Countries are increasingly exploring alternatives to traditional correspondent banking systems. Geopolitical fragmentation is pushing nations to consider faster, more neutral settlement layers. This creates an interesting environment for digital settlement networks. If cross-border friction increases under traditional systems, alternatives become more attractive. However, we must stay realistic. Governments and central banks will not easily surrender control over monetary systems. Central bank digital currencies are being researched globally. If CBDCs become dominant, private digital assets may need to integrate or coexist rather than fully replace traditional rails. This is not necessarily negative for XRP, but it changes the competitive landscape. Let's also discuss market cycles inside crypto itself. Historically, crypto markets have moved in cycles, influenced heavily by Bitcoin halving events and liquidity waves. During bullish cycles, altcoins like XRP often experience exponential rallies. During bearish cycles, they can retrace sharply. This cyclical behavior creates both opportunity and risk. If you believe in the long-term infrastructure thesis of XRP, understanding cycles allows better entry and risk management. Accumulating during deep bear markets is emotionally difficult, but often strategically stronger than buying during peak euphoria. Now, consider institutional adoption. Large institutions do not move based on Twitter trends. They move based on cost efficiency, regulatory clarity, and long-term strategic planning. If XRP infrastructure continues integrating into payment systems quietly, price may lag until broader liquidity returns and narratives align. Another macro factor is tokenization. There's increasing discussion about tokenizing real-world assets, bonds, real estate, commodities, onto blockchain networks. If financial assets begin settling on digital rails, interoperability between tokenized assets and payment settlement layers becomes critical. Networks that can handle liquidity bridging efficiently may gain importance in that ecosystem. But again, execution matters. Tokenization is still in early stages. Many pilot programs exist. Large-scale production adoption is gradual. As investors, patience and disciplined expectations are key. Let's talk about capital rotation. In every financial cycle, capital rotates from safe assets to growth assets. When investors feel confident, they move into higher-risk opportunities seeking higher returns. Crypto often sits at the far end of the risk spectrum. That means XRP's explosive upside potential is usually tied to strong risk-on environments. This also means volatility will remain part of the journey. Even if XRP becomes integrated into financial plumbing, speculative markets will amplify price swings. Infrastructure assets in early stages often experience extreme volatility before stabilizing. One more important angle is psychology. Retail investors tend to overestimate short-term gains and underestimate long-term transformations. Infrastructure revolutions look boring at first, then suddenly they appear obvious in hindsight. The internet was doubted in the 1990s. E-commerce stocks crashed before dominating. Volatility does not invalidate long-term thesis, but it tests conviction. If you are positioning around XRP, your strategy should align with your time horizon. If you are trading short-term momentum, macro cycles and technical levels matter heavily. If you are investing based on infrastructure transformation, then adoption metrics, partnerships, regulatory clarity, and network growth matter more. The real strategic advantage is combining both views, understanding macro liquidity to time entries better while maintaining awareness of long-term infrastructure trends. The transformation from analog financial systems to digital settlement networks will not be a straight line. It will face resistance, regulatory debates, competitive innovation, and market corrections. But efficiency is powerful. If XRP continues to prove faster settlement, lower costs, and integration capability, it remains structurally aligned with that efficiency trend. Now, let's talk about the most important question every investor is thinking, but very few analyze correctly. How does XRP actually capture value? And what would need to happen for the price to scale in a meaningful way? Because believing in technology is one thing, understanding valuation mechanics is another. First, we need to separate two concepts: usage and price. Just because a network is used does not automatically mean the token price goes up dramatically. The relationship between transaction volume and token value depends on demand for holding the asset, liquidity depth, and market structure. The XRP ledger processes transactions where XRP can act as a bridge asset. In simple terms, XRP can temporarily sit between two currencies during a transfer. Now here's the key. If transaction volume increases significantly, demand for XRP liquidity increases. Higher liquidity demand can increase market depth and potentially support higher valuations. But here is where many investors misunderstand. XRP transactions settle very quickly in seconds. That means XRP does not need to be held for long periods to facilitate transactions. So the value capture mechanism is not the same as a stock generating cash flow or a company paying dividends. Instead, the thesis relies on liquidity demand, network trust, and capital positioning. Let's simplify it with an example. Imagine global cross-border flows using XRP increase to hundreds of billions annually. For institutions to rely on XRP at that scale, there must be sufficient liquidity pools available across exchanges and corridors. Deep liquidity reduces volatility and slippage. As usage grows, liquidity providers must hold larger amounts of XRP to maintain efficient markets. That holding demand can support price over time. Another factor is speculative positioning. Markets price expectations ahead of reality. If investors believe XRP adoption will expand dramatically, price can rise before full adoption materializes. This is what we often see in growth assets. Future potential gets priced in early. Now let's consider market capitalization logic. XRP already has a significant circulating supply compared to many other cryptocurrencies. That means extreme price targets require very large total valuations. For XRP to reach very high price levels, total market capitalization would need to expand substantially. That is not impossible, but it requires either massive speculative inflows, significant institutional usage, or both. It is also important to understand that price per coin does not tell the full story. Market cap and liquidity depth matter more. A lower-priced asset with high supply can still represent a massive network value. So serious investors focus on total valuation relative to addressable market size. What is the addressable market? Cross-border payments alone are massive. Add remittances, corporate treasury movements, settlement between financial institutions, and potentially tokenized asset settlements. If XRP captures even a small percentage of those flows, that represents significant economic throughput. However, throughput alone is not enough. The network must become trusted infrastructure. Financial institutions do not gamble on unproven rails. They demand reliability, uptime, regulatory clarity, and legal protection. This is where the role of Ripple becomes central. Enterprise partnerships, compliance, alignment, and integration support increase the probability of real-world usage. Now, let's address token supply concerns. XRP has a large total supply compared to assets like Bitcoin. Critics argue that high supply limits upside, but supply alone does not determine value. Demand relative to supply does. If liquidity demand grows faster than available float in markets, price adjusts upward. If demand stagnates, price stagnates. Another key variable is velocity. In economic theory, higher velocity means an asset circulates quickly. XRP's fast settlement increases velocity. High velocity can reduce the need for large balances to support volume. That means for price to rise significantly based purely on utility, transaction scale must be very large. This is why many analysts say XRP's upside is tied to scale. Small adoption may not drastically impact price. Large-scale integration across multiple global quarters could create stronger demand pressure. Let's also be realistic about speculative cycles. Crypto markets often overshoot fair value during bull markets. Narratives amplify price beyond immediate fundamentals. Then corrections bring prices back toward more sustainable levels. And this volatility is part of early-stage asset classes. So what would a strong bullish scenario look like? It would likely include continued regulatory clarity in major economies, expansion of enterprise adoption, increasing liquidity corridors, integration into payment providers, and a broader macro environment supportive of risk assets. Combine that with positive market sentiment, and you can see how valuation could expand significantly. What would a bearish scenario look like? Slower than expected adoption, competitive displacement by stablecoins or CBDCs, prolonged regulatory uncertainty, or global liquidity tightening. In that case, price appreciation could remain muted or volatile. Serious investors must think in probabilities, not guarantees. XRP does not need to dominate the entire global payment system to justify meaningful upside. It only needs to secure a sustainable niche within digital settlement infrastructure. Another powerful angle is optionality. If the XRP ledger expands beyond payments into tokenization, decentralized finance, or institutional asset settlement, that creates additional demand pathways. Optionality increases upside asymmetry, even if not all pathways materialize. Ultimately, valuation comes down to belief in infrastructure transformation. If digital settlement rails become foundational to global finance, assets aligned with that transformation can benefit. But price appreciation will depend on real integration, liquidity growth, and sustained demand, not just narrative momentum.